I'm Nikki Paulser, and we're going to be looking at national income this afternoon. Right, so when we look at national income, we think of economics as a watch. And you're probably going to ask me now, why a watch? Now, as you know, within economics, people are going to have different ideas as to how they see it, okay? From my perspective, as you know, a watch keeps time, right? And it runs from the 1 right around to the 12, and then it starts all over again. And that's exactly how things in the economy works, right? There's a cycle that's taking place. And there are other factors that will impact on how the watch works. For example, your pulse might not be very good, as mine is, therefore I can't even wear a watch. So the watch just loses time on my arm. But the same way, you have outside factors that impacts on the economy, and things don't always work the way we would like it to. And if you remember in grade 10, you were taught about the exogenous factors, right? Those outside things that impact. And sometimes there might be something faulty with the watch itself that will also cause it not to work very well. And remember, once again in grade 10, you were introduced to the endogenous factors that has an impact as well. Okay. So when we look at the economy as a watch, we see here, we start at number 1, and the very first thing you're dealing with is people, right? If you remember economics and you think back to the definition of economics, which we say it is a social science, so it is not a natural science, it is a social science, because within the subject of economics, we're looking at people and we're studying the behavior of people, how they react, and what the impacts are of their decisions. So we start with the people, and then we move on. The next point there that you get is these people have needs, but at the same time, they also have, so their needs need to be satisfied, and these needs are satisfied through the goods and services, right? So goods and services are produced in order to satisfy the needs of the people. And then we have what we call our consumer goods, right? Because these are the goods that the consumer uses. And we also have our capital goods. And your capital goods is what is used in order to produce those consumer goods. So your capital goods will consist of things such as your machinery, and as you know, you have your different categories of consumer goods, which is durable, non-durable, semi-durable, right? And then we have our intermediaries, right? These are what we also, another term for intermediaries, we call them middlemen, right? And they would then act so there we have the production process then that takes place, and your intermediaries or your middlemen will be the link between the people and production. Right, so when you think about production, we have what we call our various sectors of the economy. There is the primary sector, the secondary sector, and the tertiary sector. And just remember your primary, we will look at in detail a bit later what are the businesses that we find within the primary, the secondary, and tertiary sectors. Right, and then also you've got your foreign sector as well, and then we also have the state, right? So sometimes you also have the government is involved in production, your foreign sector is involved in production, and obviously your various economic sectors are involved as well. Right, and then there is the remuneration for factors of production. And then when people earn that money, they will then use that remuneration, which they will spend on the goods and services. Right. Any surplus income that they might have left, because remember from what they've earned for the selling of their factors of production, some of that they're going to use to spend on goods and services, and they might still have some money left over, and obviously that money which is unspent would then go into savings, right? And these savings will be stored with the financial institutions. Now remember, when you think of financial institutions, it can be banks or even insurance companies as well. And then of course that monies that the financial institutions, that we save with the financial institutions is what they would then give out to businesses in the form of loans. So that would be seen as an investment into that business that they are making when they are giving money to the businesses to expand their production. Right. And then once again, you've got a foreign sector as well, who can also contribute to investments, and that would be your foreign investment, which is very important within an economy. And all of this would then lead to what we call economic growth, because as a result of the investment that is made into businesses, because that money which foreigners as well as banks, local banks or foreign nationals, they will then give to the businesses, so now the business can expand its production capacity, and that would then lead to economic growth. Because remember, that is what we're going to look at, how we calculate that, because remember, economic growth is looked at the levels of production that is happening, right? And obviously, once we've achieved economic growth, we hope that the economic development would then happen. So can you see how all of these fit together? We started with the people and their needs, and in order to satisfy their needs, there are goods and services that needs to be produced, and this is produced by these various role players, your sectors, the foreign sector and the government, and then the people will earn an income or remuneration for their factors of production. That income they will use to spend on goods and services, and anything that is left over of their income is then used as savings. That savings then would become investments, right? And it's as a result of investment that we have economic growth, and then as a result of economic growth, we can then achieve economic development. Right. A hot question that we have: why is it necessary for South Africans to save more and attract foreign investors to invest their money in South Africa? Right, as I just said to you, your capital formation, now you must have heard this term already. Your capital formation happens as a result of savings. As I said to you, the money that we save within the bank is not put into a little box with your name on it and put in a cupboard, and when you come back to take it out again. No, that money which we save with the bank is the money that is then made available to give out as loans to businesses. So businesses need access to that, as well as we need from the foreign sector as well. We need the foreign investors in South Africa, because, as you know, South Africa is not a very big saving nation. And also, if you looked at the stats, our unemployment levels have risen, and it's at about 32% at the moment. So we don't have much money circulating from the locals. So therefore, we need to attract money from outside in order for our businesses to grow. Right. So in grade 10, you were introduced to the circular flow. So if you still remember this, the definition of the circular flow, broken down into its very, very barest is the interaction between participants, right? So your circular flow tells you or gives you a diagrammatical representation of the interaction between the various participants within the economy. And your participants consist of your households, businesses, government, and the foreign sector, okay? Your financial sector is only an assistant. They're not one of the major participants, right? And then with the participants, we also have our markets, and our markets consist of the factor market, where the factors of production are sold. And then we also have our product market, where the goods and services are sold. And then, of course, we have our financial markets, which is made up of our money market and our capital market. Together forms our financial market. And then we also have, what we call the flows, which consists of the money flow and the real flow. We're going to take a look at this. Right. So there we have the households, you see, is the very first participant, right? So in economics, we refer to the households as the primary participant within the economy, right? Meaning they are the ones who gets everything going. Then opposite to households, we've got the businesses, and they are always shown opposite one another, okay? Because in a test or an exam, they might leave one of these out and ask you, what is the label for the blank space? Then you must know, if they don't give you businesses, but you see households is there, then you know those two are always opposite each other, right? So, and then there we have the state, they in the center, or government. And then, of course, we also have the foreign sector. So there are your major participants, your households, the state, the business, and the foreign sector. And obviously, because there are 4 participants shown here, that tells me this is an open economy, right? If it was that there were only 3 participants, then this would constitute a closed economy. So what's the difference between a closed and an open economy? Closed economy, you have 3 participants and no foreign sector. Open economy, you have 4 participants, including the foreign sector, right? And then obviously we have also our financial sector, which acts as an assistant here. And then we've got our factor market and product market. These two are always opposite one another as well. Right, so what happens is the households, they are the owners of the factors of production, so they will offer those factors of production via the factor market, right? And they will then offer those to the businesses. And our factors of production are entrepreneurship, land, labor, and capital, right? The businesses will then use these factors of production. Sorry, before they use, they need to now pay for the use of the factors of production, right? So the households earn an income from the sale of their factors of production. And obviously the income that is earned, entrepreneur earns profit, land, you pay rent, the labor earns wages, and capital earns interest. The business will then use these factors of production to produce goods and services, which they will offer via the product market to the households, right? And then the households has to pay for the goods and services. So in this way, they are spending their money, but from their spending, the business is earning an income. So if you look at it, you see your factors of production and your goods and services. That is what we call the real flow. And then the spending and the income, that is what we call the money flow. Right, we go a bit further. Then your factor market, your state would also use your factors of production, right? Right, so the state uses goods and services, but the state also uses factors of production, and then of course the households, and the households pay taxes to the state. So if you look at this as money that is flowing here, you see the green arrows is your money flow. So you see the households earn money, and they're spending money, and taxes are also leaving the flow. So therefore the taxes are called a leakage. And then in return for the taxes that they pay to the government or the state supplies them with public goods and services. So that is expenditure by the state now again, or government spending. So your taxes then becomes an injection. In the same way, businesses also pay taxes, and they also receive public goods and services. Right, then the economy earns an income from the foreign sector, right? How do they earn an income, right? They earn an income for the exports, right? So when we sell goods to the foreign sector, we earn some money. And obviously, when we buy imports, that is now when we are spending money. So if you look at this, your exports, that becomes an injection, whereas your imports, that is known as a leakage. Right, in the same way, businesses have savings with the financial sector, which that money, as I said, they would invest to the business in the form of loans that they extend to business. So once again, you see your savings is what we call a leakage, but that money which they invest into the business now again in the form of loans, that now again is an injection into the economy. And in the same way, households would also save, and so there we go, the real flow and the money flow. And then your leakages consists of your savings, your taxes and your imports, and your injections consist of investment, government spending and exports. And please note, these are the letters used for each of those. Right. Right, question 2, study the graph below and calculate the values represented by the letters A to F, right? And they tell you here, your total production is 10,000, your income tax is 2,000, your savings is 1,000, and the imports is 2,500. So just quickly, these here are in Afrikaans. So owerheid means the state. Firmas is obviously the businesses or firms. Huishoudings is for households or the consumer. And your buitelandse sector, that is your foreign sector. And besparings is your savings. Okay, so they want you to complete the values for A to F. So if you see, what does A represent, right? You see there, it's coming from the businesses. So the total production is 10,000, and the households or the income tax that is being paid to the state, that is 2,000, your savings is 1,000, and your imports are 2.5. Now, what I always say to learners, you start with those things that are easiest, okay? So if you look at your graph and you see immediately from the households, the savings, right, which is represented by column D. So what I would do is, if I was given this question, I would then, on my answer book, I would write down the letters. They want you to do A to F. So it's A, B, C, D, E, and F. Okay? So I'm starting with letter D, which is my savings. It's the easiest. So that is 1,000. Right? Then if I look back here again, the letter, you look at what is easiest to calculate or to see. You see there from the households, it's going to the foreign sector. So that means households are spending money there. So those are obviously the imports, and that is the letter. There we've got the letter E, F, 2,500. Right? And then we've also got from the firms going to the state, and I know the firms pay taxes to the state, so that is C, and the taxes there is 2,000, or sorry, the income tax is 2,000. And then there I've got B and I've got A as well there, right? So how much money is the firm actually earning? The firm is earning a total production of 10,000, right? And of that money, they're paying 2,000 Rand to the state for income tax. So what's left over is going to go to the households, which will be the 8,000 Rand. Okay. Right. So there we've got our, 2,500 Rand is F for the imports. I'm glad I made this mistake so that you can see how you rectify an error. You just draw a neat line through it and then you're going to write the correct answer there. So households are earning a total of 8,000 Rand, and of that 8,000 Rand, 1,000 is for savings and 2,500 is, so they're spending 3.5. So what have they still got left after their 8,000? 3.5 from 8,000, so I need my calculator, and I'm very lazy, so I just use my phone as my calculator as well. Please remember in the exam you need to have your phone, you need to have your calculator. So it's 8,000 minus the 1,000 minus, what did we say, the 2,500, and that leaves me with 4,500. Okay, right. Now we're going to look at the comparisons now. So we said injections, right? There's it again, consists of money flowing into the economy, and your injections is represented by the letter J, and it consists of investment, government spending and exports. Your leakages, this is money leaving the economy, represented by the letter L, and they consist of saving, taxes and imports. So the economy is in equilibrium where J is equal to L, which means where my injections are equal to my leakages. So, in grade 10, you were taught to calculate GDP. This is the formula we use. Remember, the letter Y in economics represents income, which is the GDP in the economy. So, it's Y equals C for consumer spending plus I for investment spending plus G for government spending plus exports minus imports. So, an increase in private consumer spending leads to an increase in economic activity. So what does that mean? That means when consumers are spending more money, it leads to an increase in economic activity, because remember, when we spend money, it means we are demanding goods and services. So the more goods and services we're demanding, the more businesses have to produce, and that is the economic activity that they are referring to, right? When they say an increase in private consumer spending leads to an increase in economic activity. The government's main expenditure is on the salaries of civil servants and also on goods and services. Now, please remember, the term civil servants as it is used in that statement means any person who works for government, in a government department, somebody who works at a provincial hospital, teachers at government schools, right? They are all civil servants. So civil servants are the people who are employed by government. So most of the money is spent on the salaries for these civil servants and also on goods and services. Then the gross fixed capital formation, also known as investment, and occurs as an increase in infrastructure, buildings, machinery, and inventory levels, meaning money spent on infrastructure development. When we talk about infrastructure development, we're not just referring to roads and that. There's also communication infrastructure nowadays that's very, very important. So there needs to be fiber connected all over. So any money spent on that. Buildings, obviously, machinery is needed, and inventory levels, that means your stock levels, right? So all of those things is what we call fixed capital formation. Then your gross fixed capital formation increases the economy's ability to provide more goods and services produced, which will then lead to or is equal to your economic growth. GDP, which stands for Gross Domestic Product, is the market value of all final goods and services produced within the national borders within a certain period. This last part is very important. If you ask to define gross domestic product or your question says, what is gross domestic product? Then you can't just say it is the market value of all final goods and services finished. You're not going to get any marks for that. It is the final value, it is the value of all final goods and services produced within the national borders within a certain period of time. And today we are going to look at how to calculate the GDP. And now my thing has moved all out of sync again. I had fixed all of this, but now it's all moved out again, right? So the first one, I'm going to write it out on the page because it doesn't look very nice on there, right? So the first one we're going to look at is what we call GDP P, and this is where we look at the basic price, right? And when you're looking at your GDP P, working at the basic price, here we are concentrating on the sectors of the economy. And the sectors of the economy, obviously, that we are talking about here is primary, secondary, and tertiary. Right? So that is the first method of GDP calculation, right? So it is GDP, known as the P here stands for, that P stands for production method, right? And then the second one that we're looking at, is your GDP I, and here we are looking at the factor cost. And the I here is for income, right? The I is for income. So, when we're talking about factor cost, we obviously here referring to the factors of production. So the items that will be listed in this method is your compensation, paid to employees, and also your net surplus, and last but not least, your consumption of fixed capital. Okay? So, if you think about it, these are your factors of production. Compensation paid to employees is obviously your wages and salaries that you are paid to your laborers. Your net surplus is the profit earned by the entrepreneur. And your consumption of fixed capital. This is another word for this, and here the accounting students will know this one. We also refer to this as depreciation, because as you use capital goods like your machinery or your vehicles, the value of that particular asset is decreasing all the time, right? So when the value of the asset decreases, that's what we call depreciation, right? Depreciation is the decrease in the value of the asset. And then the last one, the last method, this is what we call our GDP E. And here we are now, so this is where we're looking at the market price. And the E here stands for expenditure. Okay? So if you go just to go back again, so if you look at your basic price, that is what it is costing us to make it, right? So we're looking at the value being added, primary sector, secondary sector, tertiary sector. Take, for example, if we're making a bread, right? For that bread, we will need the flour, right? But before we get the flour, somebody needs to grow that wheat, okay? So that's going to happen in the primary sector, right? That wheat then needs to be turned into flour, which will happen in the secondary sector. The wheat is going to be turned into flour, and that flour is then the main ingredient that is needed to make the bread. And when that bread is then ready to be sold, that's when it lands up in the tertiary sector. So we're looking at the value that is added by each sector of the economy. So it's giving me the cost of production. Then your GDPI, which is your income method, we look at the factor cost. Here we're looking at from what is it costing me to use the factors of production. And then your expenditure method, which deals with the market price. So this tells me now what is this being sold for. So therefore, within your expenditure method, you're looking at what is being spent by each participant. So you're looking at consumer spending, you're looking at investment spending, you're also looking at government spending, now with that in mind, here you're looking at how it's being made, what you're spending on the factors of production, and here you're looking at what is being spent on the final goods and services. Now, as you know, we cannot say for certain that if I produce 10,000 units, that I'm going to sell 10,000 units. What if I only sell 9,000? Which means that my answer at the end, because remember, it doesn't matter which method I use, I must get the same answer at the end. But the first two are looking at a point of producing, and the other one is looking at the point of sales. So obviously there's going to be some difference between the two. So therefore, to ensure that they all come to the same answer at the end, we add in our expenditure method, we have what we call the residual item. Okay? We have the residual item, and then we will also still add our exports, and we will decrease our imports. Right? Your residual item can be a negative or a positive number, right? But for the rest of them, they are all positives, except for imports is negative, right? Always negative. Right. So, if you look here, GDPP, it is the calculation method is based on the addition of value added at each stage in the production process. So we're looking from a production perspective, right? So we're working out the basic price, which is made up of your primary sector, and your primary sector consists of businesses such as agriculture and mining. Then we have our and forestry and fishing. All of these make up your primary sector. Then to that, you're going to add your secondary sector, which is made up of manufacturing, construction, electricity, gas, water. And then to the secondary sector, we're going to add the tertiary sector. And within the tertiary sector, you have businesses such as retailers, insurance, property brokers, etc. And if we add those three together, that will give us our GDP at basic price, right? And what we mean by basic price, it is price before tax, such as VAT, import taxes and subsidies on products are calculated. So to convert my GDP at basic price to a GDP at market price, I have to add taxes on products, and I have to subtract my subsidies on products, right? So with the result is, this is what we're going to then have. For the production method, we would have your, like I said, the primary secondary and tertiary sector, and those three together will give you your GDP at basic price. But the basic price consists of the amount before taxes, and that is included. So now we're going to include taxes on products. For an example like VAT would be an example of a tax on products, and we will subtract our subsidies on products. And that would then be equal to my GDP at market price. Just fill in this: primary, secondary, and tertiary. Right, so there is your layout now for the production method of calculating GDP. Right, then we look at we go to the next. Right. There's the question they ask you: study the information below and answer the questions that follow. Now there are three questions so you can't really see the last question very well. So you got your GDP according to the economic activity, and they give us the primary, secondary, tertiary sector, taxes on products, subsidies on products, and the question here is, which method is used to calculate GDP? Well, how do I know which method? I look at the information given, and they're giving me the sectors of the economy, so I know that the method that's being used here is the production method. And then they say calculate GDP at basic price. So here I can just write that in now. So I've got it in front of me here. So my totals are 246,380. Secondary sector is 317,965. And the tertiary sector, you see, is the biggest of them all. It's 275,0633. So what do I do now? I have to add these three together in order to give me, they asked me to calculate GDP at basic price. So you guys can get out your calculator. So I'll just add it very quickly here. Right, so that gives me 3314975. So if I write my answer, I've got to say then for number 2, so for number 1, the answer is production method. Number 2, if I just write it as is here, 3314975, they're not going to give you any marks for that. You have to include the rand sign, and you have to include the M, because at the top here they tell you it is in a rand million. So therefore your answer has to be in a rand million. And the other thing is, if you just give the answer as is, then you're also not going to get all the marks, because it tells you in the question, show all calculations. So you need to show how did you get to this total. You took the 246,380 and you added the 317,965 and you added the 275,0630. So for that, you'll be given 2 marks for that. I think it was 3 marks for that answer. So therefore, you would be given 2 marks for that and 1 mark for showing the calculation. Okay. Right, and then the third question, they ask you to calculate GDP at market price, which is the last one here. And to get to market price, I have to add my taxes on products, which is 309,486, and my subsidies is 17,558, which I'm going to subtract. So therefore, my answer is again going to be in rand billion, and to get to that answer, it is that one there, which is my GDP at basic price, plus my taxes of 309,486 minus the subsidy of 17,558. Now you see, now I can't just do a calculation so quickly because there's now a minus involved. So I need to go to my calculator anyway. Right, just clear that off. So I've got 3314975 plus 309,486 minus 17,558, and that gives me 360,690, 3 million. Okay, and there you have those answers for those questions there. Okay, so just to clarify once again, when you are asked to do calculations like these, there is nothing that stops you from writing out the layout like this and then writing the answers in here, and you just make sure that you put in, you can put it up top here that this is in rand million, right? So then you would still be given the marks for your answers can be marked this way as well. So for that we said was 1 mark, 2 marks there, and then this was a 4-mark answer, so it's 1, 2, 3, 4. Okay, so you would still get the same amount of marks irrespective which method you use to lay out your answer. Right, the next one, we're looking at the income method now, which is the GDPI. This calculation method is based on income within the land borders earned by the factors of production. So this is the factor cost. We said it is our compensation paid to employees, which is made, which in layman's terms we call that our salaries and wages, plus the net surplus, which we know as net profit after tax, plus consumption of fixed capital, as I explained to you, also called depreciation. And when I add these 1, 2, 3 together, that gives me my GDP at factor cost. Now your GDP at factor cost is linked to the income method, and then we have plus taxes on production minus subsidies on production, okay? And then that will give you your GDP at basic price. So your taxes on production are taxes such as site and pay as you earn, whereas your subsidies on production refers to employment subsidies like learnerships. Okay, so here you can see with the income method once again, you have the same, the only difference now is that you have your factors cost listed, and then you have taxes on production and subsidies on production, but you still get to GDP at basic price. And then to convert GDP at basic price to GDP at market price, exactly the same as it was the previous one, plus taxes on products minus subsidies on products. I must just warn with this layout, students sometimes get confused which one comes first. Remember, production deals with while the product is being made, whereas taxes on products means the final completed product. So obviously the production comes before the finalized version. We get on to the next question, the next method, your GDPE. Also known as the expenditure method, is calculated by the total expenditure on all final goods and services within the national borders, and as we said earlier on, consists of consumer spending, plus investment spending, plus government spending, plus your residual item, which will be your balancing figure, as I explained to you, and then these gives you your GDE, and the letters GDE stands for gross domestic expenditure, right? And then we will take that gross domestic expenditure plus our exports minus our imports, which will then once again bring us to our GDP at market price. So therefore this GDP at market price must be the same as this GDP at market price, which must be the same as this GDP at market price here. So all doesn't matter which method I use, they must all have the same GDP at the end. So therefore, as I said, the other two methods, you see here, you've got basic price going to market price. With this one here as well, you've got GDP at basic price going to GDP at market price. But when you look at the expenditure method, there is no GDP at market price. You only got the GDE, the gross domestic expenditure. Therefore, your residual item acts as your balancing figure. So only once you see, oh, this total is bigger than the GDP at market price for the other two, then we can work out what this balancing figure must be. I go back to my example. Let's say we produced 10,000 units, but we sold only 9,000 units. So therefore, if my GDP at market price year for these 2 years says 10,000, but if I don't have that balancing figure, then this one is going to read 9,000. So therefore, I know this balancing figure here must be another 1,000, so that this in the end is also 10,000. Now we get to the next question now. Right, question 3. Study the table below and answer the questions that follow. So there they've given us the information. They've given us, it's 2016 and 2017. It's just moved out of sync again, but the rest of it is fine, so we can at least still see what's happening there. So the question here says 3.1 asks, which calculation method in the table above is used to calculate the gross domestic product? So obviously there, I once again look at what is the information that is given to me. They tell me about compensation to employees, net surplus. So already, just by seeing those two, that tells me this is dealing with the income method. So therefore, that answer for 3.1 would be the income method. 3.2 asks, give one example of tax on products. I've given you an example when I was doing the explanation. I said to you, tax on products, the one we all know so well is VAT, because all of us buy things and we have to pay VAT on that, right? Other things obviously is like import duties, etc. And then 3.3, write the missing item marked A. So here we've got GDP at factor costs, plus taxes on production, less subsidies on production. So what would A then be? So there I've got factor costs. I move from factor costs to GDP at basic price, because there's GDP at market price, right? And the one before market price is GDP at basic price. So that is why I know that that one would be, or that would be GDP at basic price. How would you convert GDP to GNP? Right, so to convert your GDP to GNP, you first of all need to understand what is meant by GDP and GNP. What's the difference between the two concepts, right? So your gross domestic product is about what's happening in the borders of the country, right? Whereas your GNP refers to all the income earned by your permanent residents of the country. So now we've got to look at, we sometimes have South Africans working outside, but we also have a lot of foreigners and foreign businesses in our country. So therefore, we've got to take out the foreigners here, and we must add the South Africans from outside. So therefore, to convert our GDP at market price to GNP at market price, it would look as follows, right? We would have GDP at market price, and to that you will add primary income. Primary income means your main source of income, primary income from the rest of the world. As I said, this is now South Africans working overseas, right, or working outside South Africa, minus your primary income to the rest of the world. And this is now all those foreign businesses or foreign nationals inside South Africa. Right? So GDP at market price plus that minus that will then be equal to GNP at market price. Right? Not only must you know how to convert GDP to GNP, you also need to understand or be able to explain what is GDP and what is GNP as well. Right. That brings us now to our last question, which is question number 4. And question number 4 says, each of the following statements are false. They're telling you it's false. Change the italicized word to make the statement true. Right. And now they've all converted to number 1 again. Okay. So number 1, consumers cannot do away with semi-durable goods because they are essential. So they're telling you the word semi-durable is incorrect. So you need to think now, what is it that they need to, that is essential, that they can't do away with, right? So obviously, your essential goods would be your durable goods. Then number 2, government spending is seen as the backbone of economic growth in South Africa. They're telling you that it's not government spending is not the one, right? Most of the spending gets done by consumers. So it is consumer spending. Number 3 here, in national accounts, investment spending is called savings, right? Savings is what gives rise to investment. So that's incorrect. So here, savings must be changed to capital formation. Number 4, gross national income or GNI gives the value of the quantity of goods and services produced minus the cost of all inputs and raw materials used during the production process. That's not your GNI. What is this here? The value of goods and services produced, right? So that would be your G, gross domestic product, not your gross national income, gross national product. Only intermediate goods are included in the calculation of total production. No, it is only final goods and services. It is important to add only the value added in each transaction. This prevents depreciation from occurring. It is not depreciation must come out there. We are trying to prevent the problem of double counting. That's what we're trying to do. And then GNI equals GDI plus primary income receipts. This is the one we just did. Minus primary income payments. They've just used different terminology here. Primary income receipts means the income from the rest of the world. Primary income payments means primary income to the rest of the world. So this GDI must be changed to GDP. Not gross domestic income, but gross domestic product. Okay, and that brings us to the end of today's presentation. Thank you very much, grade 11s.